Good afternoon, everyone. Welcome, and thank you for being here. Today, we're going to talk about how to get the most out of your retirement accounts and how to save on taxes. My name is Kurt. I'll be teaching today's masterclass. Most people have a plan for accumulating money for retirement, but far too often, that's where the planning stops, and that's not good enough. The reality is that a sound distribution strategy, in other words, a plan for taking money out of your retirement accounts, is just as important, if not more so. Before we dive into it, let's look at a little bit of my background and my company. I'm a financial advisor with Turning Point Financial. I've worked in financial services for more than 30 years. My niche is with federal employees, and our firm knows the federal benefits well. A big thanks to my existing clients that are attending today, as well as those of you that have attended before. We've been providing financial literacy webinars for about 5 years now. My company, Turning Point Financial, is a registered investment advisor. We're regulated by the SEC. We're a team of about 25. We're independent, and our home office is located in Frederick, Maryland. Today's event is educational. I'm not here to sell you anything. A copy of the slide deck is available. All you have to do is shoot me an email. I'm happy to share that with you. We have a lot to cover today. There's about 60 slides. This is going to be fast-paced, and I'm going to talk for about 30 minutes. When it comes to your retirement accounts, you probably have a lot of questions like what you see here. This is common. We're going to cover all these. Years ago, life was simpler in so many ways, and retirement was no different. Many people went to work, and when they retired, they collected a pension, they collected Social Security. There wasn't as much needed in the way of planning, and people weren't all that concerned about running out of money, since both the pension and the Social Security were generally guaranteed. For most people, that, along with whatever else they had managed to save along the way, that was enough. Today, though, things are different. Companies and even the federal government are abandoning pensions. I'm sorry if this is a surprise to many of you, but current proposals suggest new hires for the federal government will not receive a pension and will not receive health care after retirement. Employers are shifting many of the risks they once shouldered to employees, and retirees are now responsible for making more of the critical decisions that will determine how successful they are in retirement. That includes keeping up with changes to the law. For instance, Secure Act 2.0 made nearly 100 changes to the rules for retirement accounts. That was our April webinar. Maybe you attended that. The bottom line to all of this, when it comes to your retirement, you're pretty much on your own. On top of that, your retirement savings may have to last you a lot longer than you think. According to actuaries, over 40% of retirees underestimate their life expectancy by 5 years or more. Take a look at this chart to see what I mean. And this is helpful, but it's a little out of date. What I hear, read, and pay attention to from smart folks that I follow is that if you're around in the year 2030, there's a good chance you'll live to be 100. Just let that sink in for a moment and realize how far you are from 100. You're going to need more, and that means your retirement savings will have to last even longer, and that's probably much longer than most of us have considered. We've all been bogged down by what you see here on this slide. That's normal. That's okay. One of the best things you can do as you approach retirement, if you're not already there, is to beef up your retirement savings by contributing as much as possible to tax-favored retirement accounts. So how should we be contributing and where? That depends on the type of retirement account as well as several other factors. Let's begin with the traditional IRA. A traditional IRA, or individual retirement account, is a personal retirement account that offers certain tax benefits. Contributions, they may be tax deductible. And while your money's inside the IRA, it grows tax deferred. Ultimately, when you take the money out of the IRA, it's taxed. For this year, the maximum you can contribute to a traditional IRA is $7,000. If you're 50 or older, you're allowed to make an additional $1,000 catch-up contribution. Earned income is required to make any type of IRA contribution. Traditional IRA contributions, they're deductible. They're deductible unless you or your spouse are active participants in the work plan. All of you on here today likely are. That's in your TSP or in a 401k. So it's not deductible if you're active in the plan and if your income exceeds IRS threshold amounts. Those limits depend on your filing status and who's contributing to the TSP or a 401k. Many of you know there's a Roth IRA. Roths are like traditional, but there are some key differences. One of those differences is you don't get a tax deduction when you make a Roth contribution. Those are funded with after-tax money. When your money's in the Roth IRA, it's growing tax-free and it's coming out tax-free in retirement. If you've had the Roth for more than 5 years and you're over 59 and a half, then all your withdrawals are tax and penalty free. If you need to take a withdrawal sooner, you can always take out your contributions, tax and penalty free. Same as traditional IRA contributions at $7,000 and $8,000, depending on your age. There are some income limits for the Roth, and if you make too much, you may not be able to make direct contributions. Some may still be able to do it by way of the backdoor strategy, regardless of your income. This is not something that I'd recommend doing on your own because there can be tax consequences if you don't do it right and understand all the rules. You may be able to take advantage of a spousal IRA, which are special contributions that allow a spouse with compensation to contribute to the IRA of a non-working spouse. In other words, the non-working spouse can use the working spouse's compensation as their own. This is for both Roth and traditional IRAs. Does $8,000 really make a difference every year when it comes to our retirement? The answer is obvious from this graph. Here is the result of a compounding effect with a 6% growth rate over time. If your contributions are Roth, then we're talking about a lot of tax-free money here. Many of you are already familiar with the numbers associated on this slide, the amounts you can put into your work plan, the TSP, the 401k, the 403b. If not, you need to know these numbers as well as what you receive for the match. New for this year is at the bottom, which allows folks ages 60 to 63 to put even more away. Be aware, these numbers are in addition to what you can also contribute to your IRA. Yes, you can do both. Next is a slide we've seen before. We covered this in a webinar earlier this year, what to do with your money when you retire. Most of the time, people roll over their TSP to an IRA, and that's usually a wise decision. Each of these potential alternatives offers unique benefits and drawbacks, so it's usually a good idea to evaluate your options with your financial advisor. Getting money into retirement accounts, that's only half the story. Coming up with a tax-efficient way of taking those funds out and avoiding costly mistakes, that's the other half. It's far easier said than done, and a common challenge you're probably going to want some help with. In general, withdrawals from these accounts are taxed at ordinary income rates. Your withdrawals are added to your income and taxed at whatever tax bracket you happen to be in. Here's a quick look at the tax brackets for single and joint filers for this year. One of the troubling aspects of retirement planning is that the tax rate on your future distributions is a big unknown. Even if you can project your income with relative confidence, there's no guarantee that tax rates will remain the same. And while it's hard to find someone who doesn't think they pay too much in taxes now, The reality is that the top tax rates today are low in a historical context. Our national debt's at an all-time high. Our budget's not been balanced in years. Fiscal challenges for Social Security and Medicare care, they all lead many folks to believe tax hikes are inevitable. I'm not telling you anything you don't already know, and I'm not trying to scare you, but coming up with the right plan is even more important. Stick with me, and we're going to talk about that plan. Moving on and making matters even worse, your IRA withdrawals, they can cost you a lot more in ways than just adding to your income. They can also cause you to be phased out of itemized deductions, personal exemptions, various tax credits. They can increase your exposure to the 3.8% surtax on investment income. If you take an IRA withdrawal, you might have to include more of Social Security in income. And your Medicare Part B premiums, those can go up. That's just the beginning. If you want to try to avoid these issues, you need a plan. One way to minimize the tax impact of retirement account withdrawals is to avoid taking them. This allows your retirement money to grow tax deferred, keeps that nasty taxable income off your return for as long as possible. Once you reach a certain age, the law requires that you begin to take what are known as RMDs, or required minimum distributions, from any traditional retirement account. That's TSP, that's IRA, 401k. RMDs are simply the bare minimum that you must take each year to satisfy the tax code rules. Right now, RMDs are at ages 73 and 75, depending on your age. And don't forget to take it, or don't do it the right way. If so, you're going to get whacked with a 25% penalty. You can actually figure out your RMD from a table on the IRS website. I don't know anybody that does this. Most rely on their advisors to handle it. This is an example of the uniform table, and you'd simply divide your year-end balance by the number corresponding to your age. Of course, most people don't think about things in terms of factors or life expectancy, so here's a chart you might find more useful. It shows the approximate percentages you need to take out of your IRA from ages 73 to 90 to steer clear of that penalty. If you look, you'll see that each year the percentage you need to take out, it increases. That doesn't necessarily mean that you need to take out more money each year than the last. It all depends on how your account performs. RMDs can actually get more complicated, and as we've already discussed, the penalties for making a mistake, they're pretty severe. With that in mind, here are 3 common RMD mistakes that people are making. One of those is incorrectly aggregating their RMDs between different types of retirement accounts. The tax rules specifically prohibit you from combining RMDs from an IRA with a TSP or 401k. This is likely a problem for some of you that have worked at different places and you've yet to consolidate those old retirement accounts to a single IRA. You need to talk to someone about this to avoid that problem later. Another common RMD mistake is aggregating between spouses. You have an RMD for your accounts, your spouse has an RMD for theirs. Keep them separate or you'll create a problem. There's no such thing as a joint IRA or joint TSP. You must always take your own RMDs from your own accounts. And the third common RMD mistake is forgetting to take it altogether. Although this should never happen, sometimes mistakes are made. It's a fact of life. Maybe a family member was sick and you got preoccupied. Maybe you were away on your dream vacation and it simply slipped your mind. Whatever the reason, if you forgot to take an RMD or you've otherwise made a mistake, the one thing you don't want to do is forget about it and pretend it never happened. In most cases, if you do, the IRS can come back and assess the 25% penalty, along with a host of other penalties and interest indefinitely. One strategy to minimize the impact of taxes on your retirement savings, as we said earlier, is to avoid taking distributions from your IRA for as long as possible. This will allow your retirement money to enjoy its favorable tax status as well for a long time. It also helps keep income off your return, which we've already learned not only helps to keep your income tax bill lower, but can also help prevent increases in the other costs that are tied to your income. There are some major downsides to this approach, most notably, as your IRA gets bigger, so does your problem. That's what we call the tax bomb. Think about it. If your tax bracket remains about the same over time, then as your IRA grows, so does the amount you'll eventually be taxed. Thankfully, there's a way to fix this, so you can own your IRA free and clear, so that only you benefit from future appreciation. I'm talking about the Roth conversion. This is tax planning. We're making our own plan to lower our future tax bill in a big way. Roth conversion is the name given to a special type of transaction where you move money from your traditional IRA. When you make a conversion, the amount of money that you convert is added to your tax return for the year. It's taxable at whatever income tax bracket you happen to be in. Let's say you have $100,000 in a traditional IRA and you'd like to convert it to a Roth. You'll add $100,000 of income to your tax return. That's taxable at current tax rates, federal and state. You settle up with the IRS when you file your return. Obviously, this is a big decision, can have a significant impact on your taxes. It's always best to discuss this option with your tax and financial advisors beforehand. So why would you voluntarily choose to make a Roth conversion and pay taxes before you have to? Well, there are a lot of reasons, but perhaps the most compelling, we're locking in today's known tax rates versus potentially paying higher taxes in the future. You'll own the account free and clear for life and enjoy tax-free withdrawals later. There are no restrictions on who can make Roth IRA conversions. The potential tax-free nature of a Roth IRA may also provide you with additional benefits we share with you on this slide. Roth IRAs have no required minimum distributions because we've already paid the taxes. That means your Roth can continue to grow and compound tax-free for your heirs, which also makes it a very intriguing vehicle from an estate planning perspective. The Tax Cuts and Jobs Act, however, eliminated the recharacterization option for conversions made in 2018 and later. If you convert your Roth now or in the future, you're stuck with that decision. Even if your tax bill is higher than you thought, or the conversion accidentally phased out a credit, or if your investments dropped in value, no matter the reason, there's no getting out of it. There's no going back. No recharacterizations are allowed. So with that in mind, it's very important that you're sure about doing the Roth conversion. Here are 3 questions to ask yourself before converting, and the answer to these 3 questions has to be a resounding yes. Here's a conversion strategy that might be helpful. We call it filling up the tax bracket. Remember those tax brackets we looked at earlier? Oftentimes you find yourself in the middle of one of those with room to add more income without pushing yourself into the next higher bracket. For example, the 22% tax bracket for this year for married couples filing jointly goes from about $96,000 to $206,000. If you have taxable income of $100,000, that means you could add up to another $100,000 of income without going to the 24% bracket. Making a Roth conversion of some amount up to that $206,000 limit may make sense for you. Now, if you plan to convert a sizable portion of your IRA, this approach is often more tax efficient than converting the whole thing at one time. We call this a long-term tax strategy, whereby you make smaller conversions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on your converted money. It spreads the tax bill out over a longer period of time. Roth conversions can be especially helpful if you're in a low income year. These are questions to ask to see if your Roth conversion is a good move. Be aware conversions are only done in IRAs, not in your TSP, not in a 401k. A change is coming to allow conversions in your work plan, but is not yet widely available. Of course, these strategies aren't for everyone. As you see here, there's no guarantee that the Roth conversion will achieve its intended results. There's a good chance that at some point in your life, you're going to want to move around some of your retirement money. Maybe it'll be done as part of a conversion or a consolidation. Whatever the reason, you must be aware of how to move retirement money so that you don't make costly mistakes. In general, there's two ways to do it. You can move it indirectly with what's known as a 60-day rollover, or you can move it directly, known as a trustee to trustee transfer. Moving it directly is usually the wiser choice and what I recommend. Indirect rollovers, I don't know anybody that does that. I think it's a mistake. Don't do this. You don't need to take the risk. It's fraught with problems. And if you work with an advisor, they're not going to let you make this mistake. There's generally a better way to move your retirement money. That's the direct rollover or the trustee to trustee transfer. Your money is sent directly from your old retirement account to your new retirement account. And here's what that looks like. Here's what you need and want to have happen. It's a check payable to the new custodian for your benefit. If it's payable to the new custodian like this, your distribution qualifies as a direct rollover, receives a favorable tax treatment, no 60-day deadline, no mandatory tax withholdings. Best of all, it's true even if the plan sends the check to you and you forward it to your advisor. Some plans insist on sending you the check. There's simply no way around that, and that's okay. Another essential component of any retirement plan, make sure you coordinate your overall estate, tax, education, and financial plan. All your accounts impact each other in these areas. It's important to factor those things into your planning. Many of you have heard me say before that your financial life is a huge puzzle. When you pay down loans, save or invest more in one area, it has an impact on other areas. There's a process and a priority to getting it right. One way of handling this is by coordinating everything with your financial advisor. Next, we have another way to save on taxes. It's having the right investments in the right accounts. Not getting this right, it leads to leaving the IRS a tip. Everyone's circumstances are different, but oftentimes it's better to have your income-producing investments in your retirement accounts and your growth investments in your non-retirement accounts. Consider coordinating your retirement plan with your overall financial plan and carefully select which of your investments are purchased with retirement money and which investments are purchased with non-retirement money. Doing so could help you meaningfully lower your tax bill. Here's an example. We're going to look at some examples of what I'm talking about here. Let's imagine you have $100,000 in an IRA and $100,000 in a non-retirement account. Let's also imagine you want to purchase $100,000 of bonds or a bond fund, has a hypothetical interest rate of 4%, and 100,000 of stocks or a stock fund with a 4% dividend. Also assume you're going to live off this income and you're in the 24% tax bracket. In our first scenario, you see stocks are purchased inside the IRA. They generate $4,000 of qualified dividends. That means they're long-term. Qualified dividends have a special tax treatment, and they're taxed at long-term capital gains rates. I'm going to show you why that's important. These rates are lower than ordinary income taxes. However, because all this is done inside the IRA, it doesn't matter because withdrawals from IRAs are taxed at ordinary income tax rates. Here, that's 24%, which comes with a tax bill of $960. Same scenario, we're buying bonds or a bond fund of $100,000. They generate $4,000 in income, and that bond interest is also taxed at ordinary income. Again, we're in the IRA, so we're at that 24% tax rate. So we've got another $960 or a total of $1,920. Here's where it's important, this scenario. Bond purchases are made inside the IRA. They generate the same $4,000 of interest before. When that money comes out, we're at the 24% tax rate. We've got a $960 tax bill, just like before. But we have a different account now. We have a non-retirement account. We're buying stocks or a stock fund. We have those long-term qualified dividends, which are taxed at a lower rate, 15%, not 24%. So the bottom line here is our tax bill is only $600, not $960. That's a 25% difference. That's pretty big. Both scenarios, we invested exactly the same amount of money, exactly the same investments, same investment risk, but we get an extra 25% because we managed our asset location. We had the right investments in the right account. So remember, when it comes to your investments, it's not just what you own, but where you own it. And I like to say, it's not what you make, but what you keep that matters. Let's also keep in mind, capital gains rates are coordinated with your income, and those rates can be 0, 15, and 20%, depending on your income. That means some people will do this, and they'll pay no tax. Others are going to pay the 15 and 20%. We're getting in the weeds a little. Be aware, anytime you're dealing with investments, no guarantee they're going to perform as expected. I'm not anticipating any capital gains tax rate changes anytime soon, but there's no crystal ball to predict what our politicians are going to have happen. Another way your retirement plan needs to be coordinated is with your Social Security claiming strategy. The decision of when to file for Social Security is one that far too many make without thoroughly evaluating all their options. This is a major mistake and one that in some cases will cost you more than $100,000 over the course of your retirement. The decision of when to turn on Social Security, it's a very personal one. It varies significantly from person to person, couple to couple. Most of you know delaying Social Security until after full retirement age can allow you to earn an additional 8% each year until age 70. With this in mind, some of you have heard me say that retirement is not about getting the most money. There's nothing wrong with turning Social Security on early, and there's lots of good reasons why. So please be open-minded. So much goes into when you turn on Social Security. It's your financial needs, it's your health, family longevity, your other assets, what type of accounts those other assets reside in. Are they Roth assets, traditional assets, non-retirement assets? It's not black and white. Some might consider drawing from a traditional IRA to get that balance lower so they have less of a tax bond when RMD time comes around. You're also simultaneously delaying Social Security and letting that grow. This is one philosophy or strategy. Another reason this may make sense to draw from an IRA and delay Social Security is that Social Security benefits are generally more tax efficient than IRA withdrawals. Remember, when you take an IRA withdrawal, the entire amount is added to your income and it's taxed at whatever rate you happen to be at. Comparatively, Social Security benefits may be anywhere from 15% tax-free all the way up to 100% tax-free. So the key point for you here is that trading $1 of IRA income on your tax return for $1 of Social Security benefits will almost always leave you with a lower tax bill and more money to spend. Nobody talks about this, and it's likely new for most of you. Let's move along. We want to coordinate our retirement plan with our estate plan. In most estate plans, we have two goals. First, make sure your assets pass to your intended beneficiaries. And second, we want to do it as tax efficiently as possible. We're talking about two very simple things here. Keeping your beneficiaries up to date. Beneficiaries are on a TSP, a 401k, an IRA, as well as your life insurance. All those have beneficiaries. Make sure those are up to date. Second, it's highly advantageous for your heirs to inherit a Roth IRA rather than a traditional IRA. Except for your spouse, most other beneficiaries will need to take the money out within 10 years. This is known as the 10-year rule. Taking money out of the traditional IRA, that's going to push your kids into a higher tax bracket versus the Roth, which is a tax-free inheritance. Please find someone to talk to about this if you don't understand it. And if you don't know anyone, I'd be happy to talk to you about it. We're going to skip the next couple of the slides. They sort of get into the weeds with beneficiaries, and I don't want to do that. Designated beneficiaries. 10-year rule that went into effect 5 years ago in 2020. Prior to that, you were able to do the stretch, which we'll talk about in a minute. Here are exceptions to the 10-year rule. If you're in one of these categories, you don't have to take the money out over 10 years. You can stretch it over your lifespan and use your own individual RMD table. Here's what it means to stretch the IRA distributions. Eligible designated beneficiaries can take minimum distributions calculated over their life expectancy. Doing so allows these beneficiaries to minimize their income tax and maximize the tax deferral and the growth of the inherited account. A question I get a lot is whether or not an IRA beneficiary ought to be a trust. Trusts are certainly good at providing post-death control, and if that's a major concern to you, it's certainly something to consider. However, naming a trust as a beneficiary, it adds considerable complexity to your estate plan. If it's drafted properly, that trust can preserve the stretch. However, all too often, trusts don't meet the very specific requirements outlined by the IRS, and folks end up having to follow the less favorable rules, the 10-year rule. Even if it's drafted properly, trusts come with a cost. Cost to create it, cost for filing annual tax returns, accelerated taxation of withdrawals. Ultimately, naming a trust as a beneficiary, it's very complicated, something that should be carefully considered and discussed with your team of advisors. That would include your tax advisor, your estate attorney, and your financial advisor. Okay, folks, we're getting near the end. I appreciate your patience. Many people will name their spouse as a beneficiary. That's obvious. We're going to talk about that for a moment If your spouse is your sole IRA beneficiary, he or she generally has a few options after inheriting your IRA. They include choosing to remain as a beneficiary, as well as what's known as a spousal rollover. Let's tackle the spousal rollover first. Surviving spouse takes deceased spouse's IRA, they move it right into their own. Spousal IRA rollover, it's irrevocable. Once completed, the funds are treated as though they were always there. It's generally the best option for older folks, 59 and a half and older. Younger folks, they want to do what we have here on this slide. They want to remain as the beneficiary. They don't want to do that spousal rollover. And that's because it allows you to take money out penalty-free. Might be aware there's a 10% early withdrawal penalty if you're under age 59 and a half. So keep that in mind. Reach out if we can be of any help in discussing that area. I know many of you with us today, you're federal employees, your work life's certainly been disrupted. Our team, we did some work on the proposals that have been put forth that are going to impact federal benefits. We're going to be following up by sending out a summary of what may be coming your way if you continue to stay employed with the federal government. All of this is what's on the table and what's been publicly reported. I'm not an inside source, nor do I have one within DOGE. So that's coming your way. So that's it. We've covered a lot today. Certainly plenty to consider. As you probably realize by this point, retirement planning, it can be a lot more complicated than most realize. Let's face it. Deciding what strategies are best, they cross into just about every area of planning, from tax planning to investment planning to estate planning. In our experience, few are aware of just how critical retirement planning is, and even fewer have taken the time to evaluate all the issues and develop a comprehensive solution. Hopefully, we've helped to answer some questions for you, but chances are you still have others. Not to worry. Your participation today, that entitles you to a free consultation with me. If that's something you're interested in, please send me an email or give me a call and we'll get something scheduled. If you have questions, you're welcome to email me. You can check us out on the website there, TP Financial. I'm on LinkedIn as well. We're back, I believe, on June 11th with our next webinar. And you'll be getting an invitation for that. Everybody that participated today or signed up will get an invite to the next webinar. So thank you all. If we can be of help, please reach out. Have a great day. And I hope you'll join us again in the future.